Good morning. Yesterday we were discussing about methods of issuing, methods of ways of borrowing funds from capital markets. So there are two broader methods. One is by issue of equity shares and the other one is by issue of debentures. So we were discussing the uh, second option, debentures. So how debentures are different from loans and what are the pros and cons from the viewpoint of the company of issuing debentures. So we have gone through all the advantages of issuing debentures from the perspective of the company. Now let's quickly go through the limitations. So these are the setbacks. Even though debentures serves as a very economical source of funding on account of lesser rate of interest, tax deduction, no fixed certain advantages are there, but what are the disadvantages? So these are some of the major demerits, and amongst these three, the most important one being the first one, which talks about financial risk. So this is the major problem when you have debt as your major source of funding. So it's not just debentures, for that matter, any source of debt capital has financial risk. So financial risk, also known as financial leverage, something which you might have studied in your previous semesters. So what does this financial risk represents? And when does this financial risk arises? So financial risk is a situation when a company does not have sufficient revenue or sufficient profits to pay its interest on debt. So in order to meet the interest obligation when the company does not have sufficient profits, it is called financial risk. If you have to represent this in terms of a equation, then I would say if EBIT, earning before interest and tax, when EBIT is lesser than interest payable, then a company is said to be exposed to financial risk. For example, let's say a company has EBIT, earning before interest and tax, also known as operating profit of 50 lakhs. And if the interest payable is 55 lakhs or more than 50 lakhs, then a company is said to be facing financial risk. So that means the company does not have sufficient profits to meet its debt obligation. As a result of this, the company may not be in a position to pay interest. And if a company fails to pay interest, this is an indication that the company is heading towards a wrong direction. And in some cases, what will happen, debenture holders or the institutions that have given loan to company, they have the rights to uh, file a legal case against the company. They have the rights to sell the assets of the company and recover their money. So all sorts of consequences uh, will result in case if the company is not in a position to meet its obligations. So this is called financial risk. So this is one of the key challenges. And of late, most of the companies which have shut their businesses, it's mainly because of this reason, whether it is Reliance Communication, whether it is Jet Airways, right? So the main reason behind their closure was this: they were exposed to high financial risk, and ultimately they landed up in a position where they were not at all able to pay interest on their uh, debt capital, and second, they were not also in a position to repay the debt. So that's another issue, right? That is called default risk. When a company does not have sufficient cash available to pay its debt, then it is called default risk. So debentures exposes a company to both, not just financial risk, but also default risk. And the second point states rigid obligation. Now, what this rigid obligation means that a company should at any cost pay interest, provided if it is a secured loan, right? Whether it is a secured loan or unsecured loan, in both the situation, interest must be payable, right? So that's the rigid obligation, right? You can't get away with this, unlike shares where payment of dividend is optional and at the discretion of the board of directors. But here it's not like that. Whether a company has taken a secured loan or unsecured loan, interest payable is a must. So company can't run away or shy away from the responsibility of meeting the obligation of paying timely interest to the debenture holders. Third, protective measures. So in case of debentures, for certain types of debentures, this is not for all the types of debentures. Certain types of debentures uh, obligates the company to create protective measures. Now, how does the protective measures gets established? The answer is a company which has issued debentures should ensure that it meets the obligation of paying interest and also repayment of the entire loan taken in the form of debentures at a specified time in the future. So in order to do so, what will happen is a company every year from its profit and loss account will transfer or keep certain reserve only for the purpose of repaying the debenture amount borrowed from the investors, right? So this is kind of reserve, right? So from your profit you have to keep certain amount aside and use that amount kept aside to repay the amount borrowed, which is actually good because all of a sudden after, let's say, a company has issued debentures which is redeemable after 10 years, which is repayable after 10 years, and in case if the company is not following the mechanism of keeping reserve, so if it is 10 years, even if the company keeps 1 lakh reserve every year, in 10 years the company will have 10 lakh rupees to repay that. So every year the company has to take 1 lakh amount from its profits and keep that amount aside for the repayment, which is actually good because debenture holders will also be under peace of mind stating that the company has taken the steps to repay the amount, right? Every year a certain amount is set aside, which is actually good. So that's the privilege from the viewpoint of investors. Yes, it's a uh, very good right measure because it will ensure safety of their funds. But from the viewpoint of company, it eats away their profit because every year they have to remove certain amount and put that into reserve. So that's the protective measures, right? So that money which is kept aside for repayment of amount taken from debenture holders is also known as sinking fund, right? So in accounts we call that as sinking fund. So that's the money kept aside to repay the debenture holders. Now, what are the different varieties of debentures available in the market? So let's discuss the types of debentures. So in terms of convertibility, we have fully convertible debentures and non-convertible debentures. Now, what's the benefit of this convertibility? And what can you convert debenture to? You have an option of converting the debenture into a share. But is that a privilege? Is there an advantage of converting debenture into a share? I would say yes, it is a very good advantage and it's a very good option. And provided if there is any such option available in the market to buy convertible debentures, I think then you should go ahead and subscribe for it, right? But again, there are certain things that needs to be examined, which is quite essential. So we'll discuss those things. Now, assume you have applied for convertible debentures, which means that after the maturity, at the time of redemption, you have an option of either getting your money back or you have an option of getting, instead of getting the money back, you have an option to get shares. Which one would you choose? Let's say I'm buying debentures from a company in the year 2020, and these debentures have a, a maturity period of 10 years, which means I will get back my money only in the year 2030. Now, let's say this company which has issued debentures is Infosys. Now, Infosys is a listed company on both these stock exchanges. So it has also issued shares. So shares are also being traded. So when I bought debentures in the year 2020, Infosys share price was somewhere around 1,200 rupees. right? But in the year 2030, when I'll be getting my money back from the company for the debentures what I had purchased, right? So option number one, I bought the debenture for 500 rupees, which means for each debenture in the year 2020, let's assume I have paid 500 rupees. Now in the year 2030, I will get back that 500 rupees. But anyways, all the 10 years I have enjoyed the interest paid by the company. But in the year 2030, if it is a convertible debenture, I have an option of getting a share instead of getting my money back. That means if I have bought 100 debentures from the company by paying 500 rupees for each debenture in the year 2020, in the year 2030, I have an option of getting 100 shares instead of getting the money back for those 100 debentures. So in case if I get 100 shares, right, even though I just paid 500 per debenture, but when I am getting share, if the share price is good in the stock market, then I can make further money. Assume I get shares and the shares are trading in the stock market in the year 2030 at a price of 3000. Which one would you choose? Would you want your 500 rupees per debenture back, or would you want a share? Obviously, if I get a share, I can make further money, because if the share price in the stock market is, in our case, in our example, if it is 3000 change, instead of getting 500, I will get a share and I will sell that share in the secondary market and make 3000 rupees. So I'm in a win-win situation for a simple reason that all the 10 years from 2020 to 2030, I've enjoyed interest. And at the time of getting the money back, I'm getting a share which I can further sell and make nice money. So it's a win-win situation, right, for the investor, because he gets to earn interest also and he gets to make capital gains also by selling the shares. So that's the advantage of getting convertible debentures, right? But there are limits also. What if the company's performance has gone terribly bad in those 10 years? What if the share price has hit all-time low? Let's say the share price is just 20 rupees. In that case, you will be in a serious trouble, because since you had opted for shares, now instead of getting 500 rupees per debenture back, you will get a share whose value is only 20 rupees. That means you will incur a loss of 480 rupees per debenture, right? So there are both pros and cons. So you have to weigh those and then see if you want to really go for convertible shares, or you whether non-convertible, not shares, debentures would be a better option. So this is the first option, either convertible debentures or non-convertible debentures. Option number two is redeemable and irredeemable debentures. Irredeemable debentures will have continuity. That means they will go on forever. That means after buying irredeemable debentures, the company will never pay my money back. I continue to get interest for lifetime. But in case if I want my money back, then I have to sell these debentures in the stock market and I have to get my money back. So these irredeemable debentures are listed on the stock exchanges and they can be liquidated. So that's the advantage, that it's not that your money is permanently locked, but you can get your money back by selling these debentures in the stock market. And you also get interest regularly. Redeemable shares, after certain time, you will get back your money. Now we also have this registered and unregistered debentures. Debenture is like a currency note, right? The bearer is the owner, right? Let's say you're walking out of your office, you find a 2000 rupees currency note on the road. So the moment you pick up that 2000 currency note and keep it in your pocket, you're the owner of that note. Nobody else can claim the ownership, because whoever has the currency note is the owner. Similarly, unregistered debenture is a certificate issued by the company, and this certificate will not have any name. It is just a certificate. Whoever has the certificate is the owner of the debenture. So that's unregistered debentures. But what will happen in registered debenture is all the data of the subscriber will be maintained by the company. So even though you may lose, even if you lose your debenture certificate, it doesn't matter, because you can obviously go to company and inform them that you have lost the certificate, right? So your name is already, your data is already registered with the company. So nobody else can claim the ownership of the debenture. But in case if you want to transfer, let's say you want to transfer it to somebody else, you can do so, right? You have to contact the registrar and and do the transfer of the debenture certificate. But otherwise, even if you lose the certificate, others cannot claim the ownership of the debenture. You will remain the owner of the debenture. So that's registered debentures. Then you also have secured debentures and unsecured debentures. In case of secured debentures, you get collateral backup, which means that tomorrow in the future, in the near future, if the company defaults, if the company is not in a position to pay interest, then what will happen? You have the claim over the assets of the company. That means the liquidator appointed by the court will ensure that all the assets are sold and you get your money back. So that means you're in a very safe zone. Even if the company does terribly bad, becomes a bankrupt, your money still saves, provided you buy secured debentures. But in case if you end up buying unsecured debentures, in case if the company is facing severe financial crisis, then you should be prepared to lose your money, because your money will not be paid back. So you have to forget your money. So that's unsecured debentures. Then we also have cumulative and non-cumulative debentures, which is not mentioned here. So in case of cumulative debentures, what happens if a company is not able to pay interest in a particular year? It has to pay next year. So like this, in case if the company is unable to pay interest for a few years, all that interest payments which the company has missed has to be finally paid at the time of redemption. But in case of non-cumulative debentures, in case if a company misses interest during a particular year on account of poor financial performance, then you have to forget interest for that particular year, because interest will not be accumulated, carried over to next year and paid. That happens only in case of cumulative debentures. So these are the varieties of debentures which are available in the markets. And for public like us, for people like me and you, SEBI, Security Exchange Board of India, which is the regulator of stock markets, mandates that whenever a company issues debentures to public, that means to people like us, individuals like us, it can issue only NCDs. NCDs means non-secured, non-convertible debentures. So people like us can only buy secured, non-convertible debentures. So you will not be able to subscribe for other variety of debentures, because SEBI has clearly said if you're issuing debentures to individuals, you can only issue NCDs, secured, non-convertible debentures, because SEBI wants to ensure the safety of investors' funds, especially individual or retail investors like us. And that's the reason SEBI has put a restriction to companies that if you want to borrow money from individuals or retail investors, then you can issue only non-convertible debentures. Debentures can be issued at a premium price when the demand is too much, when there are more subscribers than the actual number of debentures available. If I am issuing 100 debentures, but I have more than 1,000 people who have applied for those only 100 debentures, then I can charge a premium. That means I can ask you to pay more than the face value. If the face value is 100 rupees, I can charge 120 rupees. So 20 rupees will be the premium, which you will not get it back at the time of redemption. But in case if the demand is poor, then I have to give you a discount. But you will be given full amount. That means if the face value of the debenture is 100, if I am giving you 20 rupees discount, you will be able to subscribe the debenture only for 80 rupees. But at the time of repayment, you will get back your entire 100 rupees, right? So debenture can either be issued at par value, at discount value, or at a premium, right? So this is purely depending on the demand. So if you issue at premium, demand is bad, give discount. And if there is a normal demand, right? It's not ordinary demand, then the companies generally go for par value, right? Which is nothing but the normal value of debentures. So Companies Act mandates the procedure and protocol for issuing debentures, which requires necessary approval and clearances. So the Companies Act is designed in such a way that you have to take the consent, you have to discuss for taking any important decision. It's like a parliamentary process. You're taking a important decision which can have long-term implication on the performance of the company, such decisions needs to be ratified in the board of directors meeting. So you have to call for a statutory meeting, present the proposal, right? Pass the proposal and then implement the proposal, similar to what happens in the parliament, right? But it's unfortunate that these days no discussion and debates are happening in the parliament. But in case of a company, yes, you have to follow this protocol, right? So first conduct a meeting, convene a meeting, call all the board of directors. And as I mentioned you, board of directors are not just the promoters who starts the company, right? So when we look at the board of directors of Reliance Industries Limited, of course, Mukesh Ambani is one of the important board of director because he's also a promoter, he's also a chairman. His family members are also board of directors. But apart from promoters being board of directors, there are independent board of directors also. That means they are not insiders, they are not from within the company, they are outsiders. So they ensure that the decisions taken by the board of directors, promoters will have majority of the shares. So of course, they can take decisions, but they will ensure that those decisions are not against the interest of the shareholders. That's the job of independent board of directors, right? So call and hold the board meeting and decide which type of debenture will be issued. And you have to also discuss why the company is issuing debentures, what is the purpose, how much money will be collected, how that money will be used, and how that borrowing will help the company to grow in the future, right? All this needs to be discussed. So once the preliminary things are decided, the board of directors should also appoint debenture trustees. Now, these debenture trustees comprises of institutions who are who as trustees. That means they ensure that the money is being channelized and used decided by the board of directors. Suppose if board of directors give explanation, right? The promoters, the chairman of the company is saying, okay, we need 100 lakh rupees, we need 1 crore rupees, and this 1 crore rupees we will be primarily be using to establish new branches, new outlets. So what is the objective of borrowing that money? To establish or for expansion of business. So these trustees should ensure that the money is used for the right purpose, which was decided earlier in the meeting. So they ensure that there is no manipulation and there is no misuse and fraud. So therefore, these debentures trustees are outsiders. Actually, they are banks and financial institution, or it can be a corporate body also. So let's say if I am issuing debentures, I can appoint ICICI Bank as a debenture trustees, and they will ensure that I follow what was decided, right? And most importantly, debenture trustee should be registered with SEBI. So once I appoint trustees, then I have to prepare an offer letter and invite the public. So in case if I'm issuing shares, sorry, debentures to public, then I have to invite public to subscribe for the debentures. And finally, the debentures are issued to the public. So this is the basic protocol for any kind of decision, which is a strategic decision. A company has to follow this protocol, right, of decision making. So decision making can't be done unilaterally by the chairman or by the CEO, but it has to go through board, right? So board of directors will discuss and ensure that the decision taken does not harm the interest of the shareholders. Now, SEBI also has issued certain guidelines for issuing debentures. First is who can issue debentures. So only these three categories of institutions or organizations can issue debentures. One, a public company, which means a company which is already listed on the stock exchange. That means a private company cannot issue debentures. Second, public sector undertaking. So those companies which are owned by either state or central governments. Third, non-banking financial corporations. So non-banking financial corporations, whether they are listed or whether they are not listed, right, can issue debentures. So these are the three categories of organizations that can issue debentures. Now, for what purpose can you issue debentures? So these are the different reasons for which you are allowed to borrow money from public by issuing debentures. So the reasons or the objectives can vary from expansion, diversification, establishing a new undertaking, restructuring of capital, mergers, amalgamation, right? So these are various reasons for which you can borrow money by issuing debentures. Now, how much worth of debentures can you issue? So there is a criteria on, right? So if I'm a company, how will I decide how much I want to borrow? Of course, I will calculate my fund requirements, right? So if I'm using money for expansion, so I will calculate how much money I need for expansion. But does it mean that I can borrow the same amount of money? No, the answer is there's a criteria which I have to meet. Suppose if I want to borrow 500 crores by way of issuing debentures, am I allowed to do so? No, I have to follow this quantum of issue criteria, which says that issue of debentures should not exceed more than 20% of gross current assets and loans and advances. And this criteria gets applied in case if you want money only through working capital requirements. So if you want debentures for long-term source of funding, then this criteria does not get applied. But in case if you want to issue debentures to meet your working capital requirements, then only we apply this criteria. Otherwise, this criteria is not applicable, right? But this criteria is important for long term. The previous one was only for working capital, but this criteria is for long term capital. Your debt equity ratio in issue of debenture should not exceed 2:1. So that means let's assume I'm a company which has share capital of 100 crores and I have loans of 200 crores. Now I'm planning to issue another 100 crores of debentures. In such case, my application would be rejected by SEBI. I will not be allowed to issue debentures because I'm already having a ratio of 2:1. That means my equity is 100 crore. My loans are 200 crores, which is 2:1. That means my debt is twice the equity. Now, if I issue another 100 crore of debenture, it will become 3:1. So it will exceed that 2:1 ratio. In such case, I will not be able to issue the debentures, right? So that is also a criteria which is prescribed by SEBI. And this is interest rate. So in order to attract investors, it should not the company should not get too excited and declare unrealistic interest rates. So you cannot say that, okay, I just at any cost I want money and let me declare 18% interest. Let me declare 20% interest. So that should not happen. There is an interest rate cap which is fixed by the government, SEBI. So interest rate cannot exceed 15% per annum. So usually companies don't offer such a high interest rate also. The interest rate on debentures varies from 8.5% to 11%. So 15% is something which is very unrealistic. No company offers 15% rate of interest, but companies are allowed to offer up to 15%, right? And then the debentures issued should be listed on stock exchanges so that people can buy and sell and there should not be any liquidity problem. So these are some of the criterias, and this is how the rating is done. It is mandatory for financial institutions. So it is mandatory for companies and other organizations who are issuing debentures to go for a mandatory credit rating. Credit rating is a very simple and easy to understand concept, especially for the investors. So it's a tool which investors can use and decide whether to subscribe for debentures or not. So from the investor point of view, credit rating helps them in making decision whether to invest or not, right? But how does this credit rating mechanism work? So these credit rating agencies, they study the company's prospects. They study the company's financial data, non-financial data, right? Only after doing a proper due diligence, after completely evaluating the company's present and future prospects, they give the rating. So there is a mechanism behind how rating is given, but we are not discussing that. We are just discussing from the viewpoint of investor. You have the rating available, and this rating will help you to decide whether to buy debenture or whether not to buy. So there are different credit rating agencies in India, and this rating is from CRISIL. So CRISIL is one of the leading credit rating agencies, and CRISIL has developed these uh, ranking mechanism. So if CRISIL gives triple A represents highest safety, which means the company will never ever fail in paying the interest on time. That means timely servicing of debt is 100% assured, right? CRISIL does not give assurance, it just gives rating. So you have to understand that the company's financial position is very strong. So it will never default your in money, and neither it will fail to pay your interest. Similarly, now you can see if double A means, it means very low credit risk, right? A again. So the moment you go down, the risk starts accumulating. So D means 100% company will default, right? So these are different ranking parameters, and it becomes quite easy for people like me and you to look at the rating and then come to a decision whether we should subscribe or we should avoid. So it's quite easy. And these are the institutions which have issued different types of debentures in the past. So what is the amount they have borrowed, and why, what is the maturity, right? So first company on the list is Tata Power. So Tata Power has issued unsecured, non-cumulative and redeemable debentures, and they had borrowed 1,500 crores from the market by issuing these debentures. So what is the maturity period? The money will be paid back to the investors after 7 years, and it is a private placement. Private placement means the debentures are not issued to public, but it is selectively issued to few entities only. That means people like me and you will not be able to buy it. It is issued only for selected entities. So that's the reason it is called private placement. And as I mentioned while explaining different types of debentures, the moment you see unsecured, you should become to, I mean, unsecured cannot be issued for retail investors. Obviously, it has to be other category of investors, and that's the reason it's a private placement. Reliance Industries, which also owns Geo, has again issued the same category of uh, debentures, unsecured, non-convertible, and these are tradable on the stock exchanges. So it is listed, and they have borrowed 5,000 crores, and these debentures were issued for selected private entities, right? So not for public. Then you have Mahindra Finance. It has also issued non-convertible debentures and borrowed 2,000 crores. But this was a public offer. That means people like us were also uh, were able to subscribe the debentures from the company, right? So the list goes on. Muthoot Finance, HDFC. HDFC has issued a type of debenture which is called masala bonds. Now, masala bonds is a terminology given by SEBI. So masala bonds represents debentures issued not in India but outside India, right? Debentures issued outside India, not in India. So that's the reason it becomes masala bonds. So in case of debentures, what will happen? Obviously, it has to be issued within India. HDFC is an Indian company, so it will issue debentures within India, right? But in case if the debentures are issued outside India, point there are two criterias for classifying this transaction into masala bond. First, it has to be issued outside India. Second, it has to be issued in Indian currency. Denomination of the currency should be rupees. So even though I'm issuing this, let's say in London, but people in London are buying my debentures and they are paying me in rupees, not in pounds. So this is Indian rupee denominated bond. The bond is in terms of Indian rupees, right? So this debentures are listed in London Stock Exchange, which means that it was issued in London, right? So globalization has enabled organization to procure funds from any part of the world, not like previously wherein we had an option to borrow funds only from India. Now SEBI also gives complete freedom for companies to procure funds wherever in the world where they are available at a cheaper cost, right? So that's also a good option. So these are some other institutions that have borrowed money by way of issuing debentures. Now these are the 10 companies which have defaulted interest payments. That means these companies were not able to pay interest because they did not have money, they did not have profits to pay interest. So obviously, Reliance Communication is also there in this list, which has not just a defaulted interest payment, but it has defaulted even repayment of money, right? So there is a court proceedings going on against Reliance Communication. So most of these companies have issued unsecured debentures. So luckily people like me and you were not able to buy those debentures, but it was done through private placement. So other institutions would have invested in these companies. They would not just lose the interest, but they might also end up losing their entire amount what they have invested. So that's the reason SEBI says for retail investors, you can issue only secured debentures. So whenever you buy debentures or plan to buy debentures, you can be assured that you get to subscribe only for secured debentures because your money will not be at stake, right? So this is about debentures. This is how companies can borrow money from capital markets. Option number one, by issue of debentures, and option number two, by issue of shares. But if a company is planning to issue shares and borrow money by way of issuing shares in capital market, then there are different ways of uh, issuing shares. So there are different methods of issuing shares, and that's what we're about to discuss now. What are the different methods of floating shares in the capital market? So the first one being the quite popular one, initial public offer. So what happens in initial public offer is a company which has never issued shares, right? In other words, it's a private company, right? Now, Flipkart, who are the owners of Flipkart? Flipkart is owned by Walmart, which is a US based retail giant, right? So all the promoters hold shares in Flipkart, right? Now these promoters are the shareholders. But are these shares publicly available? The answer is no. It's a private company. So that means only few individuals will be owning all the shares of the company, right? Now what these promoters want to do is, let's take the example of Flipkart. Even though Flipkart is planning to go public by issuing shares, but not in India, in US, right? So let's say Flipkart, which is owned by Walmart, and all the shares are owned by the promoters. Now they want uh, more money to expand their business, right? So option available is either you can go for loan or you can approach public. You can issue shares, right? And public will give you the funds and you can continue to expand your business. So that means Flipkart, which has never issued shares so far in its existence, will now be issuing shares for the first time. So whenever a company issues shares to the first time to the public, it is called initial public offering. So the first sale of stock by a company to public for raising fund is called an initial public offer, right? So generally companies at a certain stage in their existence has to become a public limited company by issuing shares, because all the funding cannot be done by the promoters, and you cannot borrow a huge amount of money through debt also, because that is quite expensive. And therefore, at one point in time in the existence of the company, when it reaches a stage wherein it has to grow further and growth requires financing, and that is when a company will decide that let's go public, let's become a public limited company and grow further, right? So this generally in the so I was giving you an example of Burger King, which started its operation little late in India into the other competitors. So why Burger King wants to from public by going for an IPO? The answer is so at a certain stage, the promoters will not be able to finance and fuel the growth, and that also will become uh, inviable option, and therefore equity serves as the best option for growth of the company. So this is what an IPO means, right? Sale of shares for the first time to the public, right? So whenever companies issue shares to public, you have to do some sort of an assessment to decide whether you should buy those shares or whether you should neglect. So certain critical factors should be examined to figure out whether to subscribe or whether to avoid. But for people like us, retail investors, generally you don't have to do this evaluation. It is generally done by the brokers, and the brokers will give the call. So brokers will tell you whether to subscribe or whether to avoid. Some brokers are neutral, so they don't say buy or avoid. They just come in, right? Neutral. So people like us can follow the advice of the brokers. Otherwise, if you want to do due diligence on your own, which is always good, it's always good to do analysis on your own rather than following somebody's advice, or a combination of both will also do, right? So if you want to do an assessment on your own, right, you want to do a calculation on your own and find out whether you should subscribe for the IPO or we should avoid for the IPO, then these are the parameters. These are the parameters on which you have to do an evaluation. An assessment has to be done on these parameters. Parameter number one, a strong demand. A strong demand not just for the shares. Here, a strong demand also represents the demand for the offering what the company is giving to the customers, right? So the company which is issuing shares, does the product of these company has a strong demand in the market or not? That's the first assessment what you have to do. So if Burger King is issuing shares, so do you think Burger King's product has a good demand in the market, right? Recently we had Barbecue Nation IPO also. So do you think Barbecue Nation has a good demand in the market? So that assessment is very easy to do, right? So when you look at the sales figures, when you do a comparison with the competitors, you will come to know whether the company's product has a strong demand in the market or not. So if there is a strong demand, it is an indication that people like the products, like the offerings of the company, and which is a good sign, right? So that means the customers are convinced and therefore they are buying these products. Second, you have to also see after the company plans to issue shares, how is the response from the public? Are more and more people are subscribing, or hardly there are any subscribers? So the data is released by the uh, registrar, right? So the data is released. So the data is released by the merchant banker. So merchant banker releases the data. So if a company's IPO is open for 3 days, the merchant banker will release the data. On day one, so many applications have come. If I am issuing 100 shares, on day one itself, 100 applications have come, which is a good sign, which means there's a good demand for the IPO, right? So these are, when we say strong demand, these are the two perspectives what you have to look into, right? How is the demand for the products of the company, and how is the demand for the IPO? How is the response from the public? So strong demand always represents uh, growth, right? A strong demand for a company's product indicates that customers are satisfied and convinced with the products offered by the company. Some of the other parameters includes the timing of the IPO issue. So when we say timing, it's not the timing generally followed by uh, the society, right? There are some people, there are most of the people in India who are very religious, right? Who always see whether before stepping outside the home, whether it is Rahu Kala, whether it is Yamaganda Kala, right? So when we say timing, don't think a company should also consult a astrologer and find out whether the IPO is the whether the timing is right or not. So this is not that kind of a timing what I'm talking about. When we say timing of the issue, it purely means the business cycle and economic cycles, which means you have to study the economic conditions prevailing in the economy, right? Had I issued an IPO, let's say if Burger King had issued an IPO in the month of March, the response would have been terribly bad because month of March was a situation in which there was a complete lockdown, right? All the economic activity had come to an halt. There was a migrant crisis. People were losing their jobs. So that was not the right time because economically, most of the macroeconomic indicators were bad. Even now, the situation is bad, but at least the economy is opened up. So there is a hope that recovery will happen, right? So when we say timing of IPO issue, it means not during recession, right? So never issue an IPO when the country is undergoing a recession. So it basically talks about the economic cycles. It talks about the macroeconomic conditions prevailing in the country. If the macroeconomic conditions are bad, then avoid it. If the macroeconomic conditions are good, or if it is showing a sign of recovery, buy shares, right? So that is what timing of IPO issue means. Third, industry comparable. So it's always good to do a comparable with the performance of the company which is issuing the IPO with the entire industry. So when we say industry, it means all the companies put together doing similar kind of business is called an industry. So if tomorrow a new entrant, we have Kia, which recently ventured into Indian automobile industry. If in the near future Kia wants to issue shares in India, if it wants to become a public limited company in India, what you have to do is you have to compare the performance of Kia with the entire industry. So let's say entire automobile industry, which includes all your car manufacturers, they are 20%. But if Kia has posted a profit of 13%, return on investment of 13%, it means that Kia has outperformed its competitors, which is a good sign, which means you're doing better than your uh, industry rate, right? All the automobile companies put together, if they have given return on investment of 10% of your and your company is giving 13%, it's a good indicator. It's an indicator which shows that your performance is more than the average performance of the entire industry. So it's always good to do a comparison with peers and with the industry. So that's also one of the basic factors that needs to be evaluated. Future growth. This is something where people go wrong because most of the time when we are doing analysis, our analysis are purely based on the present data. So that should not happen. So you can't decide based on past, right? Something a company would have done extremely well in the past does not mean that the same performance will also continue in the future. So you have to always look into future prospects, future growth, right? Last few decades, Maruti Suzuki was a leader in automotive industry. It does not mean that it will continue to be number one, right? Last few years, Honda or Hero Honda or Hero Motor Corporation was a pioneer, right? But it does not mean that Hero will continue to be a number one two-wheeler company in India, right? So it keeps changing on account of technological advancement, on account of change in trends. The performance of the company may get severely hit. A new technology may come tomorrow, and that new technology, the company which you're planning to buy shares, which had a very good track record in the past, may not have that latest technology, as a result of which it may lose the competitive position. Somebody else may become a new competitor, right? The future of automobile is electric vehicles. So when we talk about electric vehicles, unfortunately, Maruti Suzuki is lacking, right? So some of the companies in India lack the electric vehicle segment. They don't have, they have not procured the technology now. That's the technology which will be used in the future. Future, we may not have cars which runs on fossil fuels. So you have to think, okay, if I'm buying the shares of Kia Motors, does Kia have sufficient investment in EV, electric vehicles? Does it have the technology? So that is how you should think, that whether the even though the company is doing well now, but whether does it have all the resources what it takes to survive in the future. So assessment in that terms needs to be done. So you just can't go by the past performance and come to a conclusion that the future performance will also be good. So that is where you have to do an evaluation of the future prospects of the company. Okay, we'll continue our discussion on this, since we are running out of time, so we have to uh, wind up. So I'll quickly take your attendance. Okay, so your attendance is done. So we will meet in the next class. Take care. Have a good Sunday. Bye.